हेलो फ्रेंड्स, वेलकम टू माय चैनल। दिस इज सीए राखी अग्रवाल। आज का हमारा टॉपिक है इंडियन अकाउंटिंग स्टैंडर्ड 113 विच टॉक्स अबाउट फेयर वैल्यू मेजरमेंट्स, हाउ टू मेजर द एसेट्स और लायबिलिटीज at fair value. This standard talks about this standard provides us a guidance about the fair value measurements. In previous standard, as per IGAP, there is no such guidance available for measuring the fair value. Standard is the converged form of IFRS 13. So, in this standard, we will discuss about the needs for Ind AS 113. What was the purpose of this standard? Then we will discuss about the objective and the scope of this standard. Then we will discuss about the fair value measurement. What is fair value measurements? Then we will discuss about the key aspects surrounding fair value measurements. What are the key aspects, that is assets or liabilities, specific fair value, units of accounts, market participants, who are the market participants, what are the appropriate market for the fair value measurements, then price. Key elements, key aspects are, there are 5 key aspects for which are surrounding the fair value, that is the assets or liabilities specific fair value, then units of accounts, then market participants, then appropriate market, and then price. And then we will discuss about the valuation of non-financial assets. Then we will discuss about valuation techniques, that is inputs to valuation technology, adjustments to the quoted price, approach to valuations, applying fair value rules to liabilities and equities, applying fair value rules to offsetting items, fair value at initial recognition, and then we will discuss about the disclosure. So these are the contents of these standards. Need for Ind AS 113. What was the purpose of these standard? What are the requirement of these standard? Why this standard is introduced by the accounting board? This standard is introduced in order to determine the fair value. So normally assets and liabilities are exchanged between the parties at the agreed terms and conditions based on the price, which might not be at arm length price. Normally, in normal situation, what happen, as per IGAP standard, they generally do, because in previous IGAP, there is no such fair value measurements for determining the assets and liability, and there is no standard available, particular specific standard available for measurements of fair value in Indian in old gap IGAP. So what they do, normally people do, they exchange their assets and liabilities at terms and conditions based on the price. That price is not at fair value, means not at arm length price. What is arm length price? Arm length price means a price involved for the asset purchased and liability transferred between the market. Means arm length price means the price which is available in the market between the market participants. Fair value is always computed from the perspective of market participants, that is the price that would be received or paid on sale, settlement, or transfer of assets or liabilities to the market players. Who are the market participants? The parties which eventually transact the assets or liabilities either in the principal market or the most advantageous market in the best economic interest. Market participants, for that the principal market is available or the most advantageous market is available. Principal market is that market where the maximum number of buyers are there, maximum numbers of sellers are there, and maximum numbers of transaction takes place for purchase or sale of asset, transferring of liability. They are the market participants, and the most advantageous market which provide the highest price for the product in the best economic interest. So they are the market participants. They are not a related party. Means they are not related party. Suppose you are taking a loan from a related party, but they are giving at a lower rate of interest from the market. The same loan, if you get from the market, they will provide a higher rate of interest at 12%. But if you are getting from the related party, they will provide you a loan of at an interest rate of 4%. So that is not the fair value transaction. The transaction, because in the market, if you get that loan, you will get at an interest rate of 12%. So this transaction is not at fair value transaction. Generally, in Indian GAAP, this kind of transaction takes place because fair value measurements is not there in IGAP. But in India, all the assets and liabilities are measured at fair value. That's why these standard is introduced to provide the proper guidance for measurements of fair value. The market participants should be independent and not a related party. However, if related party have done similar transaction on arm length price, then it can be between related parties as well. So related party can do the transaction but at arm length price means at a market, at a rate available in the market, at that price they will do the transaction. They will not do an unfair transaction. The party should not be under any stress or force to enter into this transaction. There is no such stress available to the parties to do the transaction. All the parties should have reasonable and sufficient information about the same. So both the parties should have reasonable and sufficient information to get into the transaction. So they are the market participants. Arm length price means a price involved for asset purchase or liability transferred between the market participants. So we had discussed the market participants. Who are the market participants? Means they are the principal market is available for the where highest number of transaction takes place and highest maximum numbers of buyers are present, maximum numbers of sellers are present, and if principal market is not present, then we will look into the most advantageous market. Entity specific price, for example, entity specific price means generally people do as per entity specific transaction. They will not go for the arm length price, means fair value transaction. Loan is given to the shareholders at a reduced interest rate, or buying and selling of goods between the holding and subsidiaries at a reduced price, or credit period is given to the sellers who provide us maximum number of sales for a longer period. So longer credit period as compared to the market participants is given. So benefit given to the employees, loan given to the subsidiary at a lower price. These are the entity specific transactions. This standard does not prescribe the specific method that you follow this method to determine the fair value, but it says the way to apply these methods. Suppose some of the standards are there where it says refer Ind AS 113 for determining what Ind AS 105 says, recognize non-current asset held for sale. What given formula is there? That is fair value less cost to sell. So for determining the fair value, you should follow Ind AS 113. That in that standard itself prescribed to follow the standard Ind AS 113. The definition of fair value as per Ind AS 113, what it says, it should be ensured that the value reflects all assumptions and adjustments to change from transaction specific, entity specific to normal transaction, which is common for all interested parties. Market based value means based value is value should be from the perspective of market participants. That is arm length price instead of being transaction specific or entity specific. So market based value means the fair value should be at from the perspective of market participants at an arm length price. Not it should not be at entity specific price or any specific price determined by the entity. So it should be at fair value, not at entity specific. So fair value, the price based on the market participant. In Indian GAAP, no separate standard is followed for determining the fair value. As we had discussed that Indian GAAP, in old GAAP, there is no such specific standard for determining the fair value. But in India, there is a separate or proper guidance is available in the form of Ind AS 113, which is converged form of IFRS 13, available for determining the fair value. So in previous gap there is no standard available for determining the fair value, but in Ind AS there is a specific standard available for determining the fair value as per Ind AS 11. This standard does not provide any rules, it provides principles to determine the fair value. Mean this standard does not provide any rule कि आप ये rule follow कीजिए, आप rule base पे नहीं fair value determine कर सकते हो. Ind AS 113 does not provide any rule कि आपको particular rule follow करना पड़ेगा for determining the Ind AS 113. It provides a principles कि आप इस principle को follow कीजिए to determine the fair value. Rule क्या होता है? What do you mean by the rule? It is a set of boundaries or restriction. Means rules are mandatory to follow. It's not an optional. You will choose and you will apply your mind. You have to given the certain rules and you have to follow that. So this standard does not a rule based standard. It's a principle based standard. You cannot deviate from rules. If you violate the rules, it is treated as a non-compliances, and if you do the non-compliances, it should be reported in the auditor's report. But in India, a principle-based approach is followed, which does not principle-based approach means it does not set any particular restriction or boundary. In this case, you may even deviate from the principle, but the transaction must be justified transaction. If the transaction is justified, you can deviate from principle also. It does not restrict that you will only follow the principles. So Ind AS 113 follows IFRS 13 approach prescribed by the International Standard Board. It gives us a flexibility while doing the accounting. You can easily deviate from the principle based approach if you are able to justify the transaction. These principle based approach is followed by IFRS 13 also, which is prescribed by International Standard. Fair value is as per the principle based approach and not a rule based approach, which is followed in US. What do you mean by the fair value? We will discuss with the help of example. Suppose if you are giving loan to an employee at a lower than market rate, this is not an arm length price. That is not at a fair value. If you are giving a loan to an employee below market rate, it is not a fair value transaction, and Ind AS says that you will follow a fair value transaction for measurements of assets and liabilities. But in the old gap, what we do, we had given a loan to an employee at a lower rate of interest, which is not an arm length price. So in order to determine the loan interest rate at fair value, in order to make that transaction at fair value, Ind AS 113 provides proper guidance or principles to determine the fair because of these unjustified transactions. Suppose, for example, two trade receipts. Previously in IGAP, what happened? Mr. X sold goods and get 95% of its revenue from one of the customers, Mr. Y. So Mr. X, who sold goods, 95 of its goods to a customer, Mr. Y, he has given a credit period of 90 days to that customer. Other customers he has giving a credit period of 30 days. But the maximum sale from Y Limited, which he is getting, he is giving a credit period of 90 days. This is not a fair value transaction. In order to make that transaction at fair value, this standard is introduced. So suppose for example 3, how to determine the value of equity share. Equity share market value determined on quoted price. Equity shares at quoted price available in NSE and BSE determined on DLF model following Gordon formulas, or determined on William Sharpe model beta factor. So if you want to determine the value or fair value of equity shares, 3 processes available. Firstly, if the shares are quoted in the market, then you will check NSE BSE. If not quoted, then you have to determine by using the formula DLF model, that is Gordon formulas, or William Sharpe model, that is Vitafakt. So what are the importance of fair value under Ind AS regime? Now we will discuss about the importance of fair value under Ind AS regime. Shifting in accounting perspectives. Shifting, these standards is introduced for the purpose to shift from IGAAP to Ind AS. In IGAAP, primary cost model is followed, but in Ind AS, fair value model of accounting is followed. In Ind AS 109, financial instruments, they follow to determine the asset as per fair value measurements. So refer 113 for determining the fair value. Ind AS 40, that is investment property, and Ind AS 105, that is non-current asset held for. So these are the standards which says to follow the fair value as per Ind AS 113. If this standard is not available, then what happened? What was the importance of these standard? These standard gives us a specific guidance to determine the fair value. So if this standard is not available or this standard is not present, then what happened? Absence of guidelines to compute the fair value. True and fair view of the financial statement will not be achieved if you will not do the fair value transaction. And if you will not record your assets or liabilities at fair value, then it will not reflect a true and fair financial statement. In absence of standard based on to determine the fair value, it affects the true and fair views of the financial statement, and it interferes the financial fundamental qualitative characteristics, and it get violated. That is the relevance, faithful representation, verifiability and comparability or echo. And in absence of the standard based to determine the fair value, if the standard is not available to determine the fair value, it affects the true and fair view of the financial statement. It also interferes the fundamental qualitative characteristics, and it get violated. It also interfere the fundamental qualitative characteristics, that is relevance. It affects the relevance of the financial statement. It affects the faithful representation, that the financial statement is not truly fair. It also affects the verifiability or comparability of the transactions, because it violates the accuracy of the transaction. So, in absence of fair value, it does not reflect a true picture of the finance. Hence, Ind AS 113 assume significance since it ensures compliances with the. Now, the objective of Ind AS 113. What was the objective of the standard? The purpose of these standard we had discussed. We have also discussed the need of these standard, why this standard is important. Now we are going to discussing the objective of Ind AS 113. The objective of these standard is to define fair value. The purpose, the objective of these standard to define the fair value. The objective is to set out in a single Ind AS a framework for measuring the fair value. The International Board of Accounting Standard has thought that it is not possible to put in each and every standard the definition of fair value. So they had separated another standard and make another standard, IFRS 13, for determining the fair value. So reference is given in each and every standard. Go and check Ind AS 113 for the definition of fair value. So if we want to check Ind AS 105, and they mention recognize the non-current asset held for sale, fair value less cost to sell. That fair value, for that fair value they had said refer one Ind AS 113. They put the definition of fair value in Ind AS each and every standard, so the each and every standard become very wider. For that purpose, they had separated the definition of fair value and make a separate standard for defining the fair value. So the objective of these standards is to define fair value. The objective is to set a single index framework for measuring the fair value. So एक single index बना दिया गया for measuring the fair value. Disclosure requires to measure the fair value. Disclosure is also required to measure the fair value. Now, scope of index 113. What was the scope? Scope means what are applicable in this standard and what are not applicable. Applicability are where these standards are applicable and where these standards are not applicable. Index 113 का applicability कहाँ पे है? When another index requires or permit fair value measurements and measurements such as fair value less cost to sell based on fair value or disclosures about those measurements. Where any other separate standard required, like Index 109, that is the financial instrument, requires to measure the fair value, like fair value through OCI, fair value through profit and loss account. Measurements such as fair value less cost to sell based on the fair value or disclosures about the measurements. Index 113 provides guidance for doing fair value measurements, while other standard tells us to do the fair value as per the guidance prescribed in Index 113. So other standards like Index 109, Index 105, Index 40, that is the investment property. So they prescribe to check Index 113 for determining the fair value. So Index 113 provides guidance for doing fair value measurements, while other standard tells us to do the fair value as per the guidance prescribed in Index 113. So for example, Index 109 that tells us when to do fair value. Nikhil, how to do fair valuation is as per the guidance available in Index 1. Index 109, Index 40, Index 105 us when to do the fair valuation of the particular 113 provides us how to do the fair valuation as per Index 113. So there is a guidance available in Index 113 means to how to do the fair. On applicability, this standard is not applicable. किस पे applicable नहीं होता ये standard is not applicable on the measurements and disclosures of Index 113 applicable on the below mentioned standard. These standard share-based payment, that is Index 102, lease, that is Index 116, measurements similar to the fair value but not fair value, for example NRV Index 2, and value in use measurements is also not applicable as per Index 113, and disclosure is not applicable as per Index 113. Means fair value measurements is not required in the below mentioned standard. What are the standard? That is the share based payment Index 102, leases as per Index 116, and measurements similar to the fair value but not fair value. For example, NRV in Index 2 and value in use in Index 36. Means there are some standards in which fair value as per Index 113 are not applicable. Means the measurements is also not applicable and disclosure of Index 113 is not applicable. That standards are itself, they have a their definition of fair value. Like in share-based payment, these standard itself prescribe their definition of fair value. Lease asset itself describe the definition of fair value. This particular standard does not require the reference of Index 113 for the measurements and disclosures. Index 2 itself have a definition of fair value, that is NRV. Value in use, that is the impairment as per Index 36. Value in use means the present value of the future cash flows, which is to be determined as per the standard, as per the measurements available in Index 36 itself, It does not require to prescribe Ind AS 113 for the determining the value in use. So value in use, so measurements and disclosures of Ind AS does not require, standard does not require the reference of Ind AS 113. Measurements will not apply. Only disclosure of Ind AS 113 applied in the below mentioned standard. Like planned asset at fair value, Ind AS 19. Ind AS 19 requires only the measurements of Ind AS 113. They does not require the disclosure of, prescribed in Ind AS 113. Asset for which recoverable amount is fair value less cost to sell, that is the impairment, Ind AS 36, which says measure fair value measure as per Ind AS 113. So measurement is applicable in the Ind AS 36, that is the impairment, but disclosure is not applicable. Now example, there are some Ind AS which prescribes to follow the definition of fair value as per Ind AS 1. Some Ind ASs are there like fair value less cost to sell as required under Ind AS 105 for the non-current asset held for sale. So these standards prescribe to determine the fair value as per the definition available in Ind AS 113. Now fair value through profit and loss account or through other comprehensive as required under Ind AS 109 for the financial instrument. So these standard itself says to refer the definition of fair value as per Ind AS 113. Property plant equipment measured using revaluation model as required under Ind AS 16. Biological asset measures fair value under Ind AS 41 for biological asset. So Ind AS 41 also says to refer the definition of fair value as per Ind AS 1. Now what is the definition of fair value? What is fair value? Firstly, we will understand the basic concept of fair value. Fair value is the price. It is the price that would be received to sell an asset. When you sell an asset, you receive some price, or when you paid to transfer a liability in an orderly transaction between the market participants at a measurement date. So there are 5 key aspects in this definition. Firstly, the price. It is the price that would be received to sell an asset or paid to transfer a liability. Now what is liability? Liability is in two forms. Firstly, you are discharging the liability. Means you are discharging your responsibility by paying the interest to the, for example, principal. If debenture holder is there, he pays the principals to the debenture holder. So in this case, the liabilities get extinguished. He pay the debenture holder the principal plus interest. So he is discharging his liability. Means he is paying his liability and his liabilities get extinguished or repaid. And another is transferring the liability. Means he is transferring his liability to the another person. By virtue of acquisition process, the liability in these cases get transferred to one company to the another company. They are not discharging their own liability. They are transferring their liability to the another person by virtue of acquisition process, or by the liability in this case get transferred. So if a merger happens, if acquisition happens, then the one company assets and liabilities get transferred to the another company. Now the key aspects in fair value measurements. Now in this definition, there are 5 elements that are important. That is the price. Firstly, the price. What is the price? It is the price that would be received to sell an asset or paid to transfer a liability in an appropriate market. Appropriate market means there is a particular ekdam feasible market is there to exchange the assets or liability between the market participants in an orderly transaction on measurement day. So these are the 5 elements of or key aspects of fair value, which we will discuss in detail. Now we will discuss the key aspect, that is the price. Firstly, the price. Fair value is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction in the principal or most advantageous market at a measurement date under current market condition, that is the exit price, regardless of whether the price is directly observable or estimated using valuation technique. So fair value equals to available price less transaction cost. Transaction cost means brokerage, commission, STT, etc. are not a characteristics of assets or liabilities, but a characteristics of transaction. These costs, brokerage, commission, STT, are not a characteristics of assets or liabilities, but but a characteristics of transaction. Hence, it would not be appropriate to consider any transaction cost. Further, while assessing fair value, however, they would be considered by ascertaining net proceeds for determining the most advantageous market. So fair value means whatever the price available less the transaction cost. That is the fair value, because if you recognize at an available price, that is not the proper fair transaction. Suppose in order to bring wheat from the farmer's place to a consumer place, it lots of mediocres are in between. Horticultures are there in between, the wholesaler are in between, and the retailer are in between. So the price consumer which is paying for wheat is ultimately went to the farmer at a less price, because lots of middlemen are in between. Like if you sell the wheat to the consumer at rupees 90, it reaches to the farmer at rupees 60, means 30 rupees are distributed in between. Mediocre's expenses is the transaction cost, the commission which they require. So that is the transaction cost. That cost is separated in order to consider while ascertaining the net proceeds for determining the most advantageous. So net realizable value is equals to fair value less transportation cost, and transportation cost is that cost which incurred to bring that asset from its current location to the place where it is sold. That is the principal market, where maximum numbers of buyers or sellers are present to purchase the goods, to purchase the asset. Unlike transaction cost, transportation cost arises from an event that does change the characteristics of its assets, its location, and hence it is deducted from the available price to arrive at fair value. So in order to arrive at a fair value, these costs are separated from the actual price to determine the fair value. This is the key aspects of the price. Next element of fair value is the appropriate market. Appropriate market, this is to be explained. Firstly, we will explain what is the appropriate market. Suppose, for example, in Reliance Industries, it is to be traded on stock exchange, that is on BSE or NSE. On BSE, the price of the Reliance Industries is 2935.10, while in NSE, the price of Reliance Industries is 2934, which is approximately similar. There are also, if you trade on commodity, that is wheat, the price in the domestic market of wheat is 215.50, and in export market it becomes 202.25. Market, how you will determine which price you will take while calculating the fair value of equity shares. If you take the valuation of equity shares, that is the Reliance Industries, which price you will consider, which appropriate market you will take into consideration while determining the fair value of the Reliance Industries, that is the equity share. Whether you will take the BSE rate or you will take the NSE. In order to take, there are two types of market. in order to determine the fair value. One is the principal market and another is the most advantageous market. In principal market, maximum numbers of buyers are present, maximum numbers of sellers are present, and maximum numbers of transaction of the said assets or liabilities is to. So in order to check which price you will take while calculating the fair value of Reliance Industries, you will check whether you will take the value of BSE or NSE. That is the maximum numbers of buyers or sellers are present in which stock exchange, whether in BSE or NSE, or maximum number of transaction is traded in which exchange, whether in BSEs or NSE. So that price you will consider for valuation, for fair valuation of Reliance Industries. So principal market is just like perfect competitive market. Perfect competitive market, as we had read in economics, that where number of buyers are high, where highest number of buyers, sellers and transaction is there, such that no single buyer or seller can influence the market price. Means there is no possibility of influencing the market price by single buyer, because the numbers of buyers or sellers or transaction are maximum in the perfect competitive market. For example, we will take the share market or commodity market is the principal market. Lots of numbers of buyers are there, lots of numbers of sellers are there, maximum number of transaction happen. No need to see the most advantageous market. In case of shares, if you are valuing the fair value of shares, equity shares, which is quoted in the listed market or listed shares or commodity, you will directly follow the principal market. You no need to go for the most advantageous market. When you will go for most advantageous market, when you will not find the principal market. Take the example of an immovable property where a factory is there, jute mill is there, that is discontinued factory, for which you company has followed Ind AS 105 and non-current asset held for sale as per Ind AS 105. So in order to determine the fair value, how to recognize as per Ind AS 105 non-current asset held for sale, that is fair value less cost to sell. So in order to determine the fair value of Ind AS 105 for non-current asset held for sale, we have to follow Ind AS 113 to determine the fair value of discontinued operation. So the principal market for the immovable property is not present, because maximum number of buyers are not present for purchasing. There is no some market is there to purchase the immovable property. Immovable property is a contract between the buyer and seller. The individual buyer is the individual seller. Fair value is always computed from the perspective of market participants. That is the price that would be received or paid on sale, settlement, or transfer of assets or liabilities to the market players. Who are the market participants? The parties which eventually transact the assets or liabilities either in the principal market or the most advantageous market in the best economic interest. Market participants, for that the principal market is available or the most advantageous market is available. Principal market is that market where the maximum number of buyers are there, maximum numbers of sellers are there, and maximum numbers of transaction takes place for purchase or sale of asset, transferring of liability. They are the market participants. And the most advantageous market which provide the highest price for the product in the best economic interest. So they are the market participants. They are not a related party. Characteristics of market participants, that they should be independent. They are not a related party. However, if they are related parties, have done the similar transaction on arm length price. So arm length price means the fair value transaction, that it can be between the parties as well, related parties as well. The price should not be under any stress or force to enter into this transaction. All parties should have reasonable and sufficient information about the same. I am taking the example of land. Mr. A purchased a land in order to set up a factory on that land. The motto of Mr. A to purchase a land is to set up a factory on that land. And the price of that land he is going to pay for that is rupees 2 lakhs per square meter. And the same land is purchased by Mr. Z for making a school on that land. And the price of that land is rupees 4 lakh per square meter. And the same land is purchased by Mr. X for doing the residential property on that land, and the price of that land is rupees 1 lakhs. And the same land is purchased by Mr. B for agricultural purpose, and the price of that land is 70,000 square meters. So the purpose is also checked for determining the fair value. So who are the market participants? Any player in the market. This is to be explained with the help of example. Suppose the participants who are ready to pay the price depending on the valuation of that asset. In order to check the price of the building, stamp duty valuation is to be done, which is depend on the price between the market participants. Market participants means the price which is available on between the market participants depend on the locality or available in that locality and for what purpose the property is used, whether it is used for the production factory commercial use, whether it is used for residential purpose, whether it is used for an agriculture purpose. The purpose is to be checked while determining the fair value of that property. So purpose is to be checked whether used for commercial purpose or used for residential purpose. So what elements is to be checked while determining the fair value of that land? That is, valuation or depend on the characteristics of the asset, what the asset will fetch in the commercial market, whether the asset is capable of generating the income. That is also relevant for determining the fair value. Means the maximum price which an asset will fetch depending on the following situation between the market. It depends on the purpose the property is used, whether it is used for commercial purpose or whether it is used for agriculture purpose. If the land is used for agriculture purpose, you can use that land for any purpose. So you will recognize in your books on the basis of a commercial purpose. On the business perspective, you can recognize the fair value of that asset, whether that land is an agricultural land or a commercial land. Stamp duty valuation is also required, means registered valuer is also required to determine the fair value of that asset. Now the next element of fair value is orderly transaction. Firstly, we had discussed the price, then we had discussed appropriate market, then we had discussed the market participants, and now we are discussing the another element of fair value is the orderly transaction. Orderly transaction is the transaction between the unrelated party. The transaction between the unrelated party who have all available information without any distress. Means unrelated parties who have all available information and without any distress. For example, price of quoted equity share depend on the price available in the NSE and BSE. Each day these prices are fluctuating. So that market is the where the orderly transaction is done. This transaction does not depend on the price available in the entity. Means orderly transaction is not based on the entity specific transaction, which depends on the bulk transaction. Suppose value in use. Why we are discussed the value in use. How to determine impairment? Value in use Ind AS 36 impairment of asset where measurement and disclosure is not applicable for value in use. For value in use, this Ind AS 113 fair value transaction is not applicable. Measurement is applicable for impairment. Ind AS 136 says that for determining the fair value less cost to sell. Ind AS 13 measurement principles will apply, though disclosure principles is not applicable. So in value in use, Measurement and disclosure principles of Ind AS 113 will not apply, but for measuring the fair value less cost to sell of Ind AS 136, the principles, only measurement principles are applicable as per Ind AS 113. Disclosure principles are not required. So, how to determine impairment of asset? First, we will take what is impairment of asset. Impairment of asset means the comparison of carrying value of asset with the recoverable value. When the recovering value of the asset is more than the recoverable value, then the entity will recognize the impairment of. Now, what is recoverable value? It is the higher of value in use or fair value less cost to sell. Value in use. What is value in use? Means the present value of future cash flows of the assets which will able to generate future cash flows. So means the present value of future cash flow the asset will able to generate. So that is the value in use. Means what future cash flow a particular asset is able to generate in future. That is the value in use. It means what the use of that asset and how much the asset will able to generate future cash flow, depending on which the present value of the asset is determined. What was the use of that asset and how much the asset will capable to generate the cash flows, depend on which the present value of that asset is to be recognized. For that, market participants are not required to determine the fair value. It is an entity specific. Ind AS 113 says measurement and disclosures is not required for determining the value in use of Ind AS 136. But a fair value less cost to sell, which is also the second limb of recoverable value of Ind AS 36, which says that the fair value of Ind AS 36 is measured as per Ind AS 113 principles. These measurements is an asset specific. Only measurement is applicable as per Ind AS 113, disclosure is not. So this fair value is determined as per the Ind AS 1. Now another aspect is assets or liability specific fair value. Fair value is market specific and not an entity specific. No, so fair value is to be determined on the basis of market basis and not on the entity specific. Fair value measurement takes into account the characteristics of assets or liabilities. For example, the condition and the location of the assets and restrictions, if any, on its sale or use. However, the restriction or condition that might be related to a particular entity should not be taken into account because a fair value will be based on the market participant assumptions rather to an entity specific condition or restriction, which usually will not affect the fair valuation of the assets and liabilities. So it is a market specific, it is not an entity specific. It measures the an entity shall measure the fair value of the assets or liabilities using the assumption that market participant will use while pricing their assets or liability. What the market participant use while determining their fair value, that assumption is used by the entity for determining, for measuring the fair value, assuming that the market participant acts in their economic best environment. So entity specific restriction or condition is to be ignored. A rule is not followed for determining. It is a principle based standard. It is not a rule based standard. Entity specific restriction or condition should be ignored. Asset and liabilities specific restriction or condition transferred to the buyer is to be. Thanking you for watching my video. Please like, share and subscribe.